Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 19th, 2023. The S&P 500, if you can believe it, sitting at 4183. So clearing the 4180 level that we've talked about numerous times. I'm David Zarling. I'm here with David, our newest intern, Moving Day Yoakum, and Kevin, Robert Redford Ferrari. Ian is on a well-deserved vacation. And isn't it appropriate, gents, that he would be on vacation as we clear 4180 on the S&P? I know we're not at close yet, and the close knows. But if we were to stay here above 4180, maybe it's a little bit of reward for Ian for taking a vacation.
He actually told me before he left, he's like, I know it's going to close above 4180, so that's when I'm now going on vacation. Just get ready for it.
So are you saying he's not coming back from vacation? He's just going to stay on vacation now?
Well, now he's finally got a reason. I think if we close back below, he's probably going to stay there another week. It's my guess. Just throwing it out there. Guess we'll see.
He's just going to stay until it's above 4180.
Right.
So that makes sense. Yeah, I get it. That makes sense. So that's probably the most notable development from a big picture perspective and why it was important. It's a horizontal price level where sellers have shown up going back for over a year. And here we are above that. It's an area of polarity. But starting in June of 2022, it's an area where we've seen sellers show up price lower on a broad index like the S&P. We still have the August high of 22 to clear, but maybe the NASDAQ is giving us clues on whether the August high matters or not, because it so far has gone right through it. And I think that's important information. So with that, where would you guys like to start? We have a little bit of an abbreviated show today, only because of time between a client meeting and having to do our actual job of managing risk. Any place you guys would like to start? The show is your oyster.
I was going to mention a little bit of the relative breadth we've seen earlier this week. So with the market moving higher, we're seeing some of the risk on assets moving higher, including technology, consumer discretionary. And at the same time, making relative lows, we're seeing consumer staples, healthcare, utilities, just to name a few. So it's interesting to keep that in mind when the market's making higher highs with technology participating. And right being at 4180, if we see continued upside from here, those are what you want participating in a market move that'll lead you higher.
You're saying that making this, clearing this level along with seeing breadth improvement, these are positive characteristics.
Yeah, absolutely.
Yep. And by the way, welcome to the show. Thanks for being off to a great start as part of the adaptive team. Of course, we will miss Pratty. And Pratty, if you're listening to this, I can't thank you enough for your time and dedication to our team and our clients. Truly appreciated. I know our team is going to be working on a thank you package for you, and we hope you would enjoy your summer as well as your potential fall internship with Amazon, and look forward to any future relationship we have. But thank you very much, Pratty. And at the same time, David, Pratty had big shoes to fill, and I appreciate how you've put them on yourself and put on your own style to them. And you've been a great addition to the team. So welcome to being on here. Much appreciated. David is currently finishing up at UNC Wilmington with finance, and hopefully we can have you around a lot more, David. So thanks for doing this.
Absolutely. Yeah. All credit goes to Pratty. He was a great chartist, great person. And, he taught me well in the few weeks we had together. So all credit goes to him.
Amen. And you also have to be receptive, and I appreciate that. So I'm looking forward to your future as well. And it's a great team to be a part of, having you guys, whether it's you, Kevin, Dan, Ian. It's a special group. And then, of course, everybody at Client First. Just much appreciation. We're coming off of a tax season, kind of exhaling from that, did 1,500 tax returns this last year. And it's something that I know our clients appreciate, and our adaptive process is something that it's good to educate people on. So cleared at an important level. We've got potential breadth expansion. What else are we seeing? Are there areas of strength? When we talk breadth, I think you mentioned some areas there that were weak, but also some areas that are doing well. Are you bringing up a risk on, risk off relationship?
Yeah. So when you see, the more risky names, high beta, participating in a move, that means people are, putting money in some of these more risky assets, driving the market higher versus, more of a stable market where people are seeking energy names, utilities, trying to get some dividends. So I think that's definitely important to keep an eye on. And then we continue to see, SPY versus RSP, which is going to be your cap weighted versus your equal weight S&P 500. You definitely see the larger caps continuing to push higher, including Apple, Microsoft, some of the bigger tech names. So people are still in some risky assets as of right now. In confluence with the 4180 level, we're at a pretty key point of polarity where we're at in the market. So,
Kevin, how about you? I know that you also had some well-deserved time off, and you used it rather than the beach. You used it in the relaxing confines of tearing your house apart.
Yeah, which oddly enough is not as relaxing as it sounds, but it had to be done nonetheless. But really, I guess, just because we were talking about kind of breadth and a little bit of expansion there, I guess the only thing when you mention that really comes to mind, though, is when you look at like IWM, the Russell 2000, like especially today, bumping up against that 179, 180 mark. Not necessarily a great candle today. It'd have a little bit more of a warm and fuzzy feeling, I guess, if that looked a little bit better than what it does.
You're saying if we were clear like 178, 179, 180, if we were above that, that would have a little better look to it than it does on a one-day basis today, being on the lower side of its range. Is that a fair way to say that?
Yeah, definitely wouldn't hurt. It's actually kind of interesting. You look at RSI, there might be a little bit of a divergence there too, which is, a positive divergence. It's kind of slight, but it'll be interesting to see how that plays out.
Well, and it's been so interesting because really from the start of the year, like you look at 2022, market corrects both through price and time, right? Scare you out, wear you out. It drops 25% and then it moves sideways in the 20% range. Someone called that a chop fest. And in that period of time, there was an area of the market that was leading, and that was value. Whether you looked at it from a style box perspective, so your mid-cap value, or you looked at it more from sector or industry and you saw energy doing really well. And really, we've seen a real big flip year to date go towards tech, go towards communication services, energy, and some of these value areas cool off. It's an interesting point. And where I'm going with this is when you look at where small caps are on a relative basis versus the S&P, or you even look at small caps on a relative basis versus something like the NASDAQ 100, we are right at, if you used IWM versus QQQ and you look at the exact low on September 1st of 2020, that's where we are today.
Really with the S&P too. It's right there.
Yeah, exact same spot. Do we get to be surprised if from right here, right now, we see rotation as well? That's a possibility. That's the lifeblood of markets. You could see a rotation. What do I mean by rotation is it's been tech that's carried us since the beginning of the year. Do we get a rotation back into value or areas that are value versus growth? I think that would have to start right now. If that's going to be the case, if we're going to get rotation, it would have to start right here, right now. Do you guys have any pushback on that? Or do you guys think that it's most likely that we see something like the NASDAQ just continue to lead higher the rest of the way and we see energy fall off? I guess I'm not asking for a prediction, but when you look at these relationship charts, this would be logical levels across numerous items that you could see rotation back in. That doesn't mean tech's falling. It just means that some of these value areas are picking back up. Possible.
Yeah, I agree. And I mentioned earlier this week in one of our chats, RPV, which is the S&P Pure Value ETF, that's also coming up on key levels. So if you're comparing that to the S&P, for example, we have June 5th of 2020 highs also versus July and August lows of 2021, December 2021 lows. And this is talking about the relative chart
Right.
That's getting near as well. So, if value is to pop up, it seems like this would be a good spot to start seeing some of that rotation if they want to keep it alive.
You look at something like XLE, so energy, versus XLK, technology. That would be a proxy. I'm not saying it's the proxy, but something that you could look at for growth versus value. And we're right at an important level. That's I believe, a 50% retracement from the November 2020 lows, and it's at an important horizontal level. Could you see value gaining from here? You could. And really, you have to wait for that to be confirmed. You don't just get to make that assumption. But IWM, going back to Kevin's point, being at the bottom of its range, if IWM is clearing 179, that's intriguing from a risk reward standpoint, that small caps, value, things like energy could outperform if that were to take place. Of course, that's all TBD. What other things are you guys seeing from a sector perspective? You guys can go anywhere with this. Could be stocks, bonds, doesn't matter.
I mean, just to kind of build on that point you're talking about, like if you look at like a sector rotation chart, like we kind of like to use like in our lunch runs, right? I mean, coming off a market bottom into a bull market, that rotation out of tech and discretionary, you're expecting, at least, I mean, I'm not saying it has to happen this way, but it is like your communication services, industrials, materials, energy. So I mean, exactly what you just said, I guess, if that does play out, is you naturally think about sector rotation as pretty much the next step.
Oh, this is a great point. Are you referencing the different stages of market advancement and what sectors lead? Is that?
Yep.
Okay, I like this. We'll put a chart on Twitter for this. Mm-hmm. But you're saying that the next phase, we were coming off of a market bottom. What were the sectors that you mentioned there?
Well, so like tech, discretionary, kind of maybe a little bit of communication services leading. And
okay, so that's what we've seen, right?
Yep. A transition into more like value, like your industrials, energy, materials areas.
Yeah. I like this. We're going to put that out there. Mm-hmm. That's such a great point. I really appreciate it. And Kevin's point isn't this is going to happen. His point is it would make sense if it did.
Right. You can't necessarily be surprised, right? But yeah, definitely don't lock it in by any means.
That's good stuff.
I mean, not only that, right? Which I guess you'd almost have to research this further, but I don't know that just because they're participating doesn't necessarily mean that they're outperforming either, I wouldn't think.
Oh, for sure.
More than I would, but.
Right. And there's a leading characteristic in those, market advancement areas that are leading, fit that chart for sure. I'm glad you brought that up. What else intriguing or worth noting for our listeners out of the past week, or maybe it's follow through from a prior week or from a monthly perspective that you guys are seeing from a notability standpoint?
I would definitely say, one of the main things that people have been keeping an eye on this year would be regional banks. So regional banks last week, it had pretty decent bounce. Now, of course, who knows if the bottom's in? That's not necessarily the game we're trying to play.
Right.
But it is notable to note that there is RSI divergence on KRE if you look at the daily time frame. And we have seen a decent bounce. So in terms of fear and greed, it seems, at least on regional banks for the moment, the fear is starting to dissipate, which, of course, being how many eyes are on regional banks this year, that's always notable for looking at breadth and just seeing the investor psychology behind risk assets such as regional banking at the moment.
And I know we've covered in the past on this show an area like financials using XLF, holding the $30 level would be a good thing. It doesn't need to be the leader. It just needs to not be breaking that level. We're still in that scenario. We cleared 4180 on the S&P. Maybe we're holding it by the end of the day, maybe not. We could be recording next Friday and, hey, remember that show we did last week and we're all excited about being above 4180, but by the end of Friday we were below it. That's also a possibility. But right now we're above it. XLF is above 30. And a chart that I found interesting that was shared by Willie Delwish is that Apple market cap is larger than the entire Russell 2000. What do you guys think about that?
It's kind of hard to even almost comprehend, I think.
Isn't that wild?
It just kind of blows your mind.
So the Apple directionally could move one way or the other. It's the same as whatever direction the Russell 2000 is moving. Like that's how large of a market cap Apple is. It does make one wonder. It goes back to the CMT symposium, Luis Yamada talking about this interest rate environment that we could be heading into, maybe most likely heading into, which is higher interest rates from here. The 40-year cycle, we've hit the trough. We're now heading towards the peak 40 years from now. That our job as risk managers in that environment is going to be in a higher interest rate environment. And when we look at history, that we have periods of time where big caps and mega caps just became more mega. And do we really get to be surprised if we just see more and more mega cap stocks become more mega? What comes after mega? Like if you're large, then you're mega.
Ultra.
Ultra? I like it.
Ultra cap.
Ultra cap. Ooh, we better get that to the patent office.
Yeah, trademark that.
We could see this ongoing scenario where the big just keep getting bigger. And that's what carries. And this goes back to that concept of the Nifty 50. I know we're working on something here internally where maybe we get to share a new Nifty 50. And is that the market environment we're in? I think I'd like to use this as a great time to pivot, but yet related to, there's some charts you can look at that show during the last rate cycle where rates were moving higher that Japan did very well. What are we seeing out of an area like Japan?
Yeah, Japan's looked pretty good here recently, which feels like about time, because I don't know how many times you think Japan was kind of flirting with a breakout and then it just didn't materialize, but now it's actually kind of taken it and run with it a little bit.
For sure.
And especially, like, for the most part, we're kind of paying attention to the currency hedged version of that. So like a DXJ rather than EWJ, which at least recently has kind of been the better of the two. But actually, oddly enough, because I was just actually looking at this before we hopped on, I'm actually kind of curious whether or not that's going to flip, because if you kind of look at the yen, like that currency pair there, so USD, JPY, that's actually coming up to kind of an important horizontal area of resistance. So that'll be interesting to see how that plays out, that whole relationship there.
And are you talking about the level of around 137.60 from March? Or are you going further back in time when you're looking at USD JPY?
Yeah, I mean, you can even go back to kind of like late July-ish of 22.
Okay.
I carry that through. But yeah, right around that level there. Kind of your 137, 138, roughly, with a marker.
Your point is just Japan priced in dollars has been the weaker of the two. Could that be flipping?
Right. Which would be interesting to see.
Yeah, it would be. And when you look at the Nikkei as a whole, you just look at the index level, the 30,800 level, which we would be closing at new weekly closing highs that we haven't seen since 1990. David, were you even alive?
I was about negative 11 years old.
I would say I wasn't even alive, so.
Oh, great.
It's all you.
I'm feeling old. It's all me. So 1990 is the last time we've been at these price levels for Japan. That's pretty incredible. And I don't necessarily see the media crawling over. I could be wrong because I don't sit there and watch CNBC. I just don't. Maybe they are talking about Japan, but I just don't see it from a retail sentiment. I don't have clients emailing or calling and saying, why aren't we in Japan? Which is interesting because we are in Japan. But we could be potentially heading into levels we haven't seen since 89. It's a fascinating development to see Japan doing this, both at its own index level, the Nikkei 225, or as Kevin brought up, whether you're looking at priced in dollars or priced in yen, definitely some strength coming out of there. Speaking of the dollar, last week we had what we would call bullish engulfing, so price exceeding prior weeks of information on a weekly time frame. What are we seeing there out of the dollar?
Yeah, everybody had their eyes on DXY and this kind of rounded top, head and shoulders type of formation. And if you're looking at DXY, that the base of that would be around 100.7, 100.8 to around 101.3 or so. And of course, when all the sentiment was as bearish as it gets, the last 2 weeks, we've seen a pretty good bounce off of it. So definitely a good sign. It is interesting to see stocks going up as the dollar goes up. I know
Yeah, great point.
last year and the year before, that was a major theme. It was the dollar's going up, so stocks are going down. And now we are seeing somewhat of a decoupling of that over the last couple of weeks. So,
And keep that in mind, David, because I want to come back to that, the decoupling thing regarding another scenario that you highlighted before. But with the dollar, I think your point is extremely valid that if we see the dollar continue higher from here, the strength we've seen out of equities in that environment, and even internationally, seeing places hold up meaning stay up and consolidate while the dollar's moving higher off of this potential base. I know you mentioned Head and Shoulders, but it also could be, as a technician, if I can talk shop, could be a type of double bottom into prior resistance, which now might be support. We would call this polarity. It would be fascinating to see the dollar move higher when sentiment was, how many articles were about the dollar currency collapse, all these other agreements that are taking place outside of the dollar, you name it, a lot of panic. I mean, there were specials on TV about dollar collapse. I'm not saying that we can't close back below 101 or 100, but it's just fascinating to see price move the opposite direction of sentiment at the time. Maybe we are seeing some of these relationships change. Are there any other decouplings that are worth noting?
before I get on that, I was just going to mention with the dollar, you mentioned sentiment being at a low for the past few years. I think it was back in September of 22, we saw Barron's come out with their magazine cover, What Will Stop the Dollar? And it happened to be around 5 days within the top. So,
Yeah, right.
Usually those are some pretty good indicators to look at, just overall sentiment. But as you mentioned, there are some other decoupling events going on. One to note I got from Sam McCollum. Apologize, Sam, if you're listening. He goes by Honey Stocks on Twitter. He mentioned the 10-year Treasury note yield versus XLK. Typically, those perform inversely. However, over the last couple of weeks, we've seen breakouts to the upside in both. So
you're saying typically from a correlation perspective, you would see, as an example, rates or yields move higher and tech would move lower. They would be inversely correlated. Now you're saying they're potentially correlated, at least for the last few weeks, where they're both moving up together.
Right. If you look at technology, I believe it found its low back in, let's see when that was, October of last year. Treasury notes were finding their high. That correlation is pretty consistent. So when notes find their top, usually tech has found their bottom and vice versa. So this is definitely an interesting event. Now, of course, in time, we'll see if that ends up, holding true and this is just a short-term divergence. But overall, yeah, it's definitely something we don't see very often. So something to be keeping an eye on.
And this goes back into the potential column of, are there relationships that change in a new 40-year cycle of higher interest rates? And I want to be careful because, you can't just sit there and say, oh, all these relationships are broken. You have to be open-minded enough to say, do some of these things change when the cycle changes? And it's interesting also to note that while S&P is trying to break to the upside out of its range above 4180, you use 10-year, I'll use 20-plus year treasuries using something like TLT, still within its range and falling. And I know Dan Gorkuber on our team shared its breakdown. That's probably another important development this week, is that treasuries broke down. They're still within a major range that goes back to November of last year, but the range that had developed, if you want to call it the sub-range that had been in place since March, that broke down. And so the other narrative that's going on in the background is that the Fed is going to pause. Wouldn't that be interesting, is if bonds are actually telling us no, that rates are going higher?
Yeah, and I think some of that is also coupled with what we're seeing with the debt ceiling talks, not to give in to any of the fear, but we can see if we're looking at something short term like a US 1-month treasury, those are currently yielding 5.5%, and it's been stuck in a range for a couple of weeks. But it seems like traders and investors have kind of paused and are, anticipating some type of response in terms of raising the debt ceiling. Now, it's been 78 of 78 times that they've raised it. I'm not going to fight the data on that one, but I think some of that has spilled into the market of people, just waiting to see what's going to happen as these rates continue to get pushed up in some of these bonds. So people are pricing in a little bit of worry in that case if you're looking at a 1-month treasury.
And I think pivoting off the rate scenario is there's what I would consider a interest rate sensitive area of the market like real estate also showing some important signs this week. You guys want to touch base on that?
Yeah, I had shared a chart not too long ago. So real estate, along with the rest of the market, has been consolidating for, a little bit over a month now. So starting back in early April, maybe even you could argue late March for some assets. But for real estate, it's been about 5 weeks within a range, and we're taking out the low. So we have the S&P taking out its high today, and then we have real estate consolidating just below its support. So if you're looking at something like XLRE, you have that support level around 36.4 or so to about 36.6. And now we spent about 3 days just sitting right under it. So the relative strength continues to get lower compared to the S&P for real estate. So definitely some correlations there with what we're seeing in the interest rate market.
For sure. So we've talked a little bit about stocks, although we stayed domestic. We talked Japan. Anything, Kevin, internationally besides Japan worth highlighting this week? Otherwise, I'll let you pivot to anything you want. It could be crypto. It could be commodities. Anything there, Kevin, that worth noting for our listeners?
On the international side, I know Mexico is one that kind of we've been watching and participating in a little bit. Been holding up pretty well for the most part. And actually, really, I guess, with Argentina as well. So kind of a couple areas in Latin America that are holding up pretty well. Other than that, I know we talked quite a bit about Europe previously, but I guess not so much, anymore. It's still holding up, but you're not necessarily getting, kind of the outperformance you were previously.
Oh, just from a relative basis standpoint.
Yep.
Yeah, That makes sense. You brought up Argentina and Mexico. That is interesting that you could see some dollar strength here. I don't want to give the illusion that something like Argentina is outpacing the move of the dollar. It is negative this week for a 1 week period, but it is also Argentina is well above and consolidating above the $38 level on something like ARGT. That's a pretty big base that goes back to January of 2018. January 2018, everybody understands as being, we've covered on here numerous times, the period of Volmageddon, and maybe, just maybe, we're clearing out the aspects of what happened under Volmageddon because we're still below, forgive me guys, but I'm going to use some technical analysis on the VIX. We're below the rate of trend that's been in place since the end of 2017, beginning of 2018. From that point forward until recently, we had seen higher lows in the VIX, the premiums of options, the daily volatility or monthly volatility measurement, and we're still consolidating below that rate of trend. It would be a really interesting development if the VIX were to be below 15. No idea if that happens, but it's also notable that maybe 5 years later, we're finally clearing out the effects of some of the short vol that was going on in 2017. Kevin, how about if the dollar is following through from last week, anything from commodities that you'd like to highlight?
Yeah, well, interestingly enough, bringing up kind of decoupling and, correlations, things like that. I know we covered that quite a bit last year with how we had a scenario where you have the dollar and commodities both going up at the same time, which, it was well before, really historically, it was pretty much expected that wouldn't be the case. And really, if you look at, I guess, on a more broad picture this year, as the dollar really started pulling back, you kind of saw the same thing from commodities there as well. I would say kind of more short term. It's not clear whether or not that's going to continue, but I think it just kind of goes to prove that point that, these relationships and these correlations definitely aren't static throughout time. So
that's a good point.
Definitely have to keep that in mind, but the change, and that's something time frames too. Some of these relationships can seem more static over 20, 30, 40 years, and you could have intermediate time periods where there's divergences and they could just go back to what you normally expect. You just never really know.
For sure.
That's why you play the game, I guess, right?
It's why we use price charts. Is the only way to understand when things are correlation or have significant correlation, or the only way you can do that is through price charts, is analyzing that relationship, doing the math on it. You can't just do that by looking at some fundamental report. It's important to be able to use price charts to identify when these things are in season, when they're out of season. It is. I think of gold and the dollar. That's a relationship as time tested as there's ever been. Gold up against that 2000 level using futures. Pause this week with the dollar strength. That relationship's still intact, but there's all these other relationships that you have to pay attention and know that they change. There's times where they last for years, months, and there's times where they're out of favor, or not out of favor is not the right word, where they're uncorrelated at different times. The market is never a market of certainty. The only thing certain in markets is uncertainty. And so we deal with fat tail environments, and that's an important concept to keep in mind. And I think as we're getting to the end of our time, it's important to make sure that I highlight sponsor of this podcast, which is the Adaptive Select ETF, which is listed on the NYSE under ticker ADPV. Adaptive Select helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. Adaptive Select is distributed by Quasar Distributors, LLC. Gentlemen, I appreciate your time. Anything else before we close out that you want to highlight that's for our listeners before we get out of here?
I think the last thing I'll leave everyone with was an interesting statistic I shared with the team yesterday, which was yesterday, Thursday, May 18th, was the highest call volume NASDAQ has seen since 2014. Just an interesting thought.
And that call volume probably is defined. There's two sides of that, right? Interest in call volume and the desire to sell calls, right? Because we've had a pretty big move out of, and you said this was NASDAQ?
Correct, yep.
Right? If you've had a big move by the NASDAQ, and this goes back to this, do we see sector rotation from here? Big move out of the NASDAQ. It's been the leader year to date. If you're an investor, doesn't that make sense to sell calls here? That could be the case. And I know that we had a good chuckle as a team this week from, I believe it's Ed Yardini, puts out research, and the amount of large speculative shorts going into this week or into the prior weeks, it's off the charts, but to the bottom side. So you have this juxtaposition of large call volume at the same time, large short positioning. Do we see this melt up environment where lower VIX, we're clearing 4180, the squeeze is on, and we're moving 20% higher, because all shorts are future buyers. Time will tell. But I think that's an important thing to highlight. Kevin, how about you?
We kind of touched on commodities, I guess, on the ag side of those. Kind of seeing the grains sell off a little bit, which, if you think in terms of seasonality, it's kind of a, I guess, what's the correct way to word this?
Oh, just like the period of time we're heading in from a fundamental perspective, like this is where we're planting, this is where we're heading into harvest season in 3 or 4 months. Is that where you're going with this?
Yeah, you'd have, I guess, lower expectations of performance during this time seasonally.
Right.
Or it's kind of on pace there, I guess. So I guess you can't be too shocked about that. But actually, on the cattle side, the live cattle, feeder cattle have been holding up pretty well. Which actually, I'm not seasonality wise, I'm not too sure actually how that plays out. It's actually, I'll have to kind of peek at that a little bit.
I'm just wondering if you're going to try to go grow cocoa in Wisconsin.
I don't think that would even work, would it?
I don't think so either. But
indoors, maybe.
Cocoa's been moving.
Yeah.
And sugar's just sitting there. Sugar's been one of the top performing commodities going back to the beginning of the year. Obviously, software and apps and anything intangible that's made with code is obviously made with sugar because they're both correlated. Anyway, we've reached the end of our time. I really appreciate you guys being part of this, allowing Ian a week off. Obviously, we'll do this again. If you're listening to this and you appreciate the information, we do ask you to share it. Give us a high ranking. It helps us get the word out. Otherwise, you guys enjoy the rest of your weekend.
Have a good weekend.
Have a great weekend, everybody. We got to do that for Ian since he's not here.
Yes. Well done. Talk to you guys next week.
See ya.
Bye.